categories, hybrid categories. Even the index fund. Hello scholars. Today we are going to discuss third type of mutual fund, that is index fund. We started discussion about active funds, then we discuss about exchange traded funds, and today we'll discuss index funds. This will complete your entire spectrum of mutual funds and ETF. Under the active funds, there can be different categories: equity categories, debt categories, hybrid categories. Even the index funds, same category might be applicable. Exchange traded funds, same categories. Now, these categories are based on the underlying asset where mutual funds or ETFs are investing. Okay. Now, let's compare all these three: AIE, active, index funds, and exchange traded funds. What is the difference? Active funds are unlisted. They are not traded on the stock exchange. You have to buy directly with the AMC or aggregator. Index funds are also not listed on the stock exchange. You have to buy via aggregator. Exchange traded funds are listed. So this one sentence you remember: active unlisted, index unlisted, ETF listed. Second sentence: index funds and ETF are passively managed. I repeat, index funds and ETF are passively managed funds in which they track the index. There is no active involvement of mutual fund manager. Since they are passive funds, their expense ratio is very low and costs are low. So whatever the cost, if cost is low to investor, that is good. However, don't go into judgment which is the best. You are going to invest in all three. Okay. There is a very wrong habit of some people. They just want to get only one single correct answer. That is not always true. There can be multiple correct answer. There can be multiple best. You are going to invest in all three depending upon scenario and your requirement. If you want to compare active, index, and this, there are certain parameters I wrote here. So let's say here, these are the active funds, these are index funds, and these are ETF. Alpha and beta is not applicable to the index funds and ETF because they themselves are index. So how can they beat themselves? Next, tracking difference and tracking error. Okay, tracking difference and tracking error is applicable to index funds and ETF because they are passively managed and they are just copying the index. It is not applicable to the active funds. R square is supposed to be low in the active funds and it should be high in the passive funds. Standard deviation, yes, we need for all to understand the day-to-day variation or risk. Shortage ratio, we need all for all. Drawdown is the risk parameter which we need in all. Expense ratio of active funds is maybe 2.5, 2 or 1. But in our scenario, we take active funds which has less than 1% expense ratio. But in a market, there can be 2 or 2.5 as well. Index funds are usually lesser than the active funds. Their expense ratio is around 0.5. Now there is a range. It's not true. It is not that everyone will have 0.5. Some might have 0.6, 0.3 and 2, but you got the idea. ETF, they have expense ratio maybe 0.1, slight here and there. Exit load is not applicable to the ETF. Okay, because it is real-time trading. Now I'm going to show index funds. So you go to the valueresearchonline.com. This is a free website. Although there is a paid version, you don't need paid version at all. Okay, free version is more than enough for your analysis. Click fund screener. Go to the category here. Select, now first I'll show the equity category. Select all equity funds, or let's say equity excluding the sector funds. So first click is here. Then go to the others and go down and select the management style. passive. Under the passive, see there is index funds, ETF, and funds of funds. As of now, ignore ETF, just keep index funds. Okay, so this is in management style. Click here. Now you'll get the list of the index funds. So there are 178 index funds. Remember AIE, active funds, index funds, ETF. Now we selected only index funds, and that too in equity. There may be more in the data as well, but what we selected here now is this one, index funds in equity category. There can be index fund in data as well, hybrid as well. You have to check it. First, let's focus on the index funds in equity category. There are 178 funds. Now you see the some funds are very new. Their asset under management is just 6 crore. You need index fund, any index fund, or whether it is ETF or it is or 500 criteria. Keep it in mind. 500 asset under management. So there are enough number of index fund. These are index funds. Okay. नाम में क्या रखा है? Who said Shakespeare? But in case of mutual fund, everything is in the name itself. नाम में बहुत कुछ रखा है. What does it mean? It means the first part is the name of AMC. Second part is the name of the underlying index. Third part is God. That is either growth, open-ended, or direct. In case of index funds, direct is mentioned because there is something called as regular as well. Write down in ETF there is no God. In index funds and active funds there can be regular plan as well. But just see naam mein kya rakha hai. So what is the most important part here is the underlying index, and here it will be direct. So underlying index will decide the risk return aspect of that particular mutual fund. So middle name is extremely important while selection of index funds as well as active mutual funds and even ETF. Middle name, father's name. Okay. So if you see the now these are the index funds and their return should be able to track the index. Now we can find the SIP return if you done SIPs in some of the index funds. Let's say 5-year SIP. So here are 58 funds, and now we select this. Okay. So this is the 5-year return. Okay. 5-year SIP return. 3-year SIP return. And when you want to select, let's say you want to select index funds, and then the criteria is the same which I discussed. I'll summarize in the live session again how the criteria of selection. Okay, this is just one time task. Once you understand, it becomes very easy. Go to the risk stats, and here you will find that when we see the index funds, alpha beta are not relevant here. Ideal beta should be 1 because it is itself is an index, and alpha should be 0. But you see some mutual funds are giving some positive alpha, negative alpha. Our expectation it should be 0. Okay. If someone is having positive alpha, that means they are taking some another risk and they are doing some other active involvement which is not desirable here. Now here again you see the R square. It is a correlation square, and in case of index fund, R square should be high. That means that should be 1.9, etc. If R square is less, that means a mutual fund is not actually tracking the mutual fund index but doing something else. Okay. For example, here, this R square is 76%. 0.76. What does it mean? Whatever the performance of this mutual fund, only 76 is explained by the index. Rest is because of active investment. That means this name is misleading. Although this is index funds, this fund manager is doing actually active trading, active investing. Okay. This is not desirable because we have separate category of active funds. Why to invest into the misnomer? So R square should be high. It will be up to 1. Okay, 0 to 1. So it should be 1 R square in the index fund. Alpha should be 0. Okay, negative alpha is not good, 0. Even positive alpha is not desirable. If you are looking for the positive alpha, then go for the active funds, not the index fund. Your aim in index is it should be replicate as that of index. Beta is not relevant. What is relevant here is the now Shortness ratio, standard deviation. These 2 points are relevant for the risk assessment, shortness ratio and standard deviation. Okay. And you see the expense ratio. If you click on the fees, you will see that their expense ratio is very low. Okay. I said zero 0.3, but some are showing zero 0.8, and but most of them are, if you go down, they are less than 0.3. Okay, lowest I'll show, lowest expense ratio is zero 0.1. Okay, almost 0.0, see 0.1. So these are having lowest expense ratio. Okay, exit load is applicable in some cases it is not. Okay, so exit load is applicable in some index funds, and active there will be exit load. So these expenses and exit load are important consideration in index funds as well. Okay, now let's go. If you want to select, check any mutual fund, that I'll also select. Now when you select long term, here it is a trailing return. Okay, let's select one of the top fund, which is let's go to here. This is index funds, and if you want to do analysis of single fund, the parameters remains the same. Check is first is portfolio, 99% equity. So this is equity fund. First, when you select, first check the name. Okay, first name, middle name. So middle name is here the index. It is the next 50 index which is tracking, and last name is direct God, either God, one of these three. Then go to the next to the portfolio and find out the portfolio. Okay, then you can check the other parameter where we say that expense ratio AUM, is AUM criteria fulfilled? Yes. Expense ratio 0.3, yes. Turnover as of now, forget. Exit load, there is no exit load. Okay, then next, where do you go? To the risk stats. In risk stats, stats means statistics. In index funds, alpha, beta, you don't have to look at. Okay, see here it is 0.2 because anyway we want 0. So what is the parameter you see? Is the standard deviation and shortness ratio. And then you have to compare. So this is a fund. What about index? This is the index which tracking, and the standard deviation is higher than index, which should be same, but it is little higher. Maybe they are taking little slightly variation. And shortness. Okay. Again, we say the shortness ratio should be more than 1. Why? Because shortness ratio tells us the risk adjusted return. That means portfolio return minus FD return divided by the standard deviation. If a shortness ratio is less than 1, what does it suggest? It means either return is less or standard deviation is more. Then only shortness ratio. So you have to check that shortness ratio should be more than 1 in index funds as well. Right? Then you can go and check the returns, return parameters, how much return funds has, that fund has given. There are discrete return, that is annual, year on year, where you can compare with the index as well as equity. Okay. Now you see that there is now remove the category. First see the index. Ideally, this fund should be exactly like the index. If fund is giving more return than the index, what does it mean? They are doing some active investing as well. Okay, it should be exactly like this. So our desirable is this: the index and fund should be same return. If you check the equity in the category, our fund should be have higher return. Okay, if you go to trailing return, the same thing which we discussed in the active funds, same thing will be applicable here. Where is in category and how is return more than the uh, index? Write down in index, we do not expect more return than the index. However, we do not expect less return than the index. It should be zero or slightly more. We don't want too much return. Maybe 1% extra one. That's okay. But it should not be less than index. If it is less than the index, then it is not performing good. They are doing, even despite of passive fund, they are doing some turnover and churning. So that is what our aim is, that index fund should not do the churning. Okay. So this is how you do the analysis of index funds. So it is more or less same like active funds, but there is a little difference. Okay. Now I will show the index fund in the debt category as well. Let's go to the debt category. So what I'll go and I'll select now, instead of equity, I'll select the debt category and I'll show the index. So let's select the all debt fund, and category we will select the index funds. There are again 108 funds in a debt category. These are index fund. Remember, AIE, active funds, index funds, ETF. Now we are talking about index funds. Go and check. So when you are screening, you can just do the screening here. Now you see highest return is 9% in this category. Okay, 987, because these are investing in the debt products, so they will not give more than 10% usually. They will have 6 to 9. Some will, so now some are giving 7. So this is what we place, that this debt fund should give more return than the FD, but they will not give more than 10% by and large, unless they take risk. So 7 to 10% is the debt fund, and these are the different funds available. If you see the asset under management, are there some funds? Yes, there are many funds which has more than 500. Okay, 500 crores AUM. You can download this data as well, okay, in Excel format and do an analysis. Now, if you check the risk stats of debt fund, I will see here. And here we are selecting the debt index fund. Okay. Here again, alpha is not relevant, beta is not relevant. What is relevant is Short-term ratio and standard deviation. If you check the standard deviation of debt fund is assets very low. Now it is 2% only. Okay. So these are very less risky fund. If you want to check any fund individually, go and there, check the first name, middle name. This is the first name. Aditya Birla Sun Life is the first name. Middle name is, this entire is the middle name up to here. Index fund is the this category, and then direct plan. Then go to and find out the other parameters of AUM and age. So this is 5 years almost done. AUM is fulfilling, expense ratio is fulfilling, no exit load. Go to the risk stats. This should be your reflex sequence. Go in the same sequence. And in this case, alpha is not relevant, but what you can see that Sharpe's ratio, standard deviation. In case of debt, you are expecting standard deviation very low, 1, 2, 3, etc. Not to 15, 20. Sharpe's ratio, it should be always more than 1. Where is in category? If there are 24 in category, now it is in the top, I think it's second. So we look for this. So if you want to invest for the debt fund for the protection of the capital, this funds might be suitable because it is fitting in the risk stats, and go to the return as well. Okay, not only risk stat, we have to check return category, return under the return as well, and find out where is in category. Okay, so we look for the 1 year, 3 year, 5 year. We don't look at short term because short term is not ideal. So 1 year, 3 year, 5 year. So now this is 3 year. It is behind the category. That means as per by return, it is not good performing. So return also important criteria. So this is not into our list because return is less. Let's say check someone which is giving good return in 3 and 5 year category, and then we'll check it's a in debt fund we don't do SIPs as such. We can invest anytime. There is no risk. So let's say this fund is giving 9%, and here, if you click the return, you see its rank. So now in this here, you can see it's the first rank in out of 31. Okay. Now, if you see the portfolio, you will see that where are they investing? Okay. So they are investing in government bond. So SOE means sovereign government. Right? Everything is in a government bond. That means this is a very safe fund as per as the default risk. Government will not default. Okay. Now let me add one more point here, and it is related to debt fund. Okay, debt it can be index or this point. You always look for, in case of the way we see the standard deviation in the equity as a risk parameter. Here you can see a McCulloch's duration. Okay, lesser the better, and this represents the interest rate risk, the change with the interest rate. If interest rate of RBI increases, bond prices goes down. It is inverse relationship. So this, now it depends upon a time horizon. Okay, so we should be aware that this is the risk of related to the interest rate. One more parameter we look when we invest is the yield to maturity. Okay, now yield to maturity is a calculated return. It is a calculated return on the assumption that if you invest in that bond and stay till maturity, and the interest is reinvested at the same rate, whatever the return you will get is the yield to maturity. Okay, this is just a calculated value, but this is helpful to us to select debt fund or debt product yield to maturity. The way we select FD based on the interest rate, so here you select the YTM, higher the better. In general, debt fund gives you 6 to 10% of YTM. Okay, so this YTM is one more criteria to select debt product. Okay, so this is about index funds. Okay, so now based on this, there will be so many categories: active and equity. Right here, index and active, index plus equity, index and equity. Here, ETF and equity. Here, active and debt, active and hybrid, index and debt, index and hybrid. But this is not available. Too many. Yeah, this hybrid. Let's check hybrid index hai kya? Hybrid index. Now this you might have come with the expectation that our investment should be so easy. Then why mutual fund managers and finance industry professionals are making life complicated? See, this is their business. Their business. They are in the business to make money for themselves. So it is not their responsibility to make things simple. It is your responsibility to. So now I'm talking about hybrid and passive and index. I think there are no funds. Okay, so here hybrid index funds are not available. Even ETF and hybrid will not there. So it is, yes, active and debt, active and debt, index and debt. Yes, index and debt hai. In ETF and debt, ETF and debt. So now you see so many types of mutual funds available for investing. Okay, mutual fund सही है but complicated भी है. Okay, so now in this matrix we have active on and equity. So there should be 3 by 3, but these two are not available. That means at least there are 7 types of mutual funds available based on this active index and exchange and equity, debt, and hybrid. Okay, these two are not available. But out of this seven, now you are getting so confused what to do, which is the best, how to. Don't worry, we will make your life simple. Rest. See, when you are learning, you learn everything. Okay, become a student and learn everything. But when you start applying, you you don't need all this information. The way, let's say, you do the MD or DNB or MBBS, you learn everything, but when you actually do the practice, you need limited information. Similarly, even if you are engineer, you learn a lot of during the engineering, but at the practice there is limited. But at the time of learning, you learn everything, and I'll give you a tip to how to simplify all these things. Okay, thank you very much.